Hey everyone, it's Imran with your macro options spotlight, and it's Friday. Remember, like, subscribe, comment, ask questions, do whatever you like, but we want to get the algorithm passing this around so people can learn about options and learn this information. All right, choppy intraday session yesterday. We had flagged that would probably be the case, that we'd get some intraday chop. Whether or not we managed to maintain the moves by the end of the day, we weren't so sure about, and as it transpired, the moves were quite small by the end of the day. So S&P only finished the day up about 34 basis points after CPI. Now, what did we get that chop? What was that all about? It was really about the whisper number for the CPI. Everyone's expecting another big miss. Market had already started to rally in anticipation of that. So then when the numbers came bang in line with expectations, then that was considered a bit of a hawkish data point, even though it wasn't necessarily hawkish. And that's why we knee-jerked lower. But then we did see dip buyers come in again as we anticipated, and they took the market back up again. So kind of played out as we kind of would have thought based on how the print came out. Now Russell 2000, nice little misprint there. I've put 200, but Russell 2000. I hope all of you realize there's 2,000 stocks in the Russell. Was the best performer in the US, up nearly 2%, whereas Nasdaq and S&P obviously not so much. Europe grinding out some more gains, and China taking a breather. Looking across commodities, again, they roared higher, led by precious metals, which had been taking a breather the day before, but clearly gold, threatening now to break out this 1900 level. And if it does go, then who knows how far it goes. We have been hearing that China is the marginal buyer here. They've been buying tons and tons of this stuff. And stealth buying as well. So you've got the official buying from China, then you've also got a lot of other entities within China that have been buying physical gold, and we think that's driving some of this rally. So whether or not we get that short-term pullback that we've been looking for remains to be seen, but I don't really want to fight against that flow, so I'm certainly not going to be buying any more put spreads anytime soon if China continue buying. Looking at vols absolutely hammered. We did see after CPI, we thought that would kind of be the case, down 2.5 to 3 vols in the US indices, and also down in Europe as well, and China. VIX now down below the 20 level, so the VIX spot got below 20. It's making a test for that 18 to 19 range, which has been the lows of the last year. Whether or not it takes that out, we'll see. But if it does take it out with this kind of focus shifting towards micro with earnings season, if indices do go range bound for a couple of weeks, don't be surprised for that 18 level to get broken. And we may even set a lower trading range in the VIX if we were to get a Goldilocks scenario coming through for markets. Commodity vols were also lower. Decent shifts, about 2 vols there across the board. Nat gas vol kind of hanging in there, as that's still quite a volatile beast. All right, moving on to the dollar. Obviously, the dollar took a hit. Another leg lower after that CPI. Euro had a nice up move, 1.5 standard deviation move there in euro. But the biggest mover again was yen, down to that 129 area now. People calling for potentially 125, and also some more news on Bank of Japan, which we'll talk about in a minute. Bonds also having a strong showing, up 2% on TLTs. So that continues moving. And whilst the implied vols are coming down in bonds, as we've been anticipating, the realized vols holding up quite well in TLT. So we'd really need to see realized vol come down to around 15 to 18 to kind of justify any more weakness in TLT implieds. And then in sectors, ARC up another 2%. That makes it 14% on the week, which is a pretty solid move for those beaten up tech names. And then you've got commodity sectors still roaring, energy up 2% and metals up another 2%. I mean, metals is up 10% on the week. That's having an amazing week. Okay, moving on. So Bank of Japan, that's really the big story. So obviously we've got earnings, we've got inflation expectations out today in the US. But the thing that's kind of caught my eye is what's going on in Japan. So you can see that the dollar yen has broken down. We touched a 128 handle on this move. Obviously, the move had started with the dollar move yesterday on CPI, but this kind of spooking of bond markets in JGBs has kind of led to further yen weakness, and people are getting pretty spooked. The skew in dollar yen has caught a bid again, and we're going to have to see what Bank of Japan say next week, but there's a lot of anticipation now. Now, if they were to raise it again and you see another leg lower in Japanese bond markets, that could filter through to treasuries. But you've also got the idea that they're having to buy a ridiculous amount of bonds right now. Since they moved that cap, the amount of bond buying that they've needed to do to defend the cap at 50 basis points has been immense. And that is the worry, because if they need to dump treasuries to continue to support their bond market as they're doing these steps higher, then that could filter through to treasuries and that could take yields higher. So we do think the risk is rising of bond markets, having a bit of a dramatic leg down on Bank of Japan and what they do. We're not necessarily calling for it, but we do see that left tail risk, and therefore I don't really want to be short put on TLTs anymore. Something I've been talking about as an okay way to fund some other stuff. That's not looking as attractive anymore to me if there is some risk of Bank of Japan really going for it and shifting their policy a lot higher. So that's the thing that's really got me thinking and watching closely right now, and I'll probably use today as an opportunity to get out of that, because US bonds don't seem to be reacting much to this just yet. Then moving on to the VIX. So the VIX has obviously had a big move lower. We've been calling for the VIX to go lower after CPI, and also with the focus shifting to earnings. Whole curve has shifted down. So you can see over the last month, there's been a pretty big shift down in VIX. Normally you get the front going more, but you've had almost a parallel move down there. So even those medium-term contracts getting hit. The VVIX had its move already. So we kind of flagged that last week that the VVIX had gone down, and we thought the VIX was going to follow at some point, and that seems to have materialized. And the VVIX has been quite stable this week. Now, if we do get a phase of Goldilocks in markets, then we could see index vols break even lower. Okay, so that floor at 18 that's kind of been putting in around here, if that floor gets broken, we may then set up a new trading range of 15 to 18 while we wait for things to happen, basically, right? So that is potentially a risk there. We've got Fed Fund futures now pricing in a near 100% probability of 25 basis points in the next FOMC meeting. And we're seeing macro cross-asset vol collapsing all over the place in FX, in bonds, and in equities. So there is potential for macro risk to take a breather as we wait for more evidence that the recession is imminent in the hard data, which we haven't seen yet. And so markets could go a little bit range bound, okay? So if earnings don't disappoint too badly across the board. So we'll see sector dispersion in earnings, but we may not need to see broad indices move that much if we get some up and some down. So what I would say, and this is through my experience of trading vol for many, many years, don't be caught off guard by how low vol can go. Okay, sometimes we get into this mindset that vol's flawed. Oh, it's too cheap, it's flawed, and it just keeps going lower because there's no actual reason for it to go up, because there's no movement, right? If realized collapses, vol's going to collapse with it, right? So we need realized to continue to persist. We think there's a window where index realized might actually collapse, and if that does happen, don't expect the floor on vol to hold. It could very easily give way. Okay, so that's my thought there on VIX. And then last slide, really, no trade idea for today. Kind of, we're in a bit of wait and see mode at the minute. VIX open interest and flows. So it's we've taken out the January expiry, which is next Wednesday options, just to see what the landscape looks like on VIX. You can see the kind of pillars building here, big red pillars building. There was a lot of this activity at the end of last year in the 70 to 80 area on VIX. That was where the tail risk hedging was coming in. But we had a lot of options expire in December, and now we're starting to see that replenished, particularly in March. So we saw the March 30 to 40 area trading in big size this week, 48,000 lots, which is kind of 5 million Vega notional clips in the 30 calls and the 40 calls on VIX in March. That may have been a call spread, or it may have been a call strip. We don't know for sure. We think the call spread structure makes more sense. You're buying a 10-point wide call spread there for about 60 cents. So the risk reward looks pretty decent, and you have a hedge in the book that carries relatively well because it's a call spread, something that we've suggested in our 42 macro overlay discussions with Darius. But the point being that upside interest is building now as vols come down, as VVIX comes down. All those things are making upside look more attractive, and there's a load of hedging potentially that rolled off in December that needs to be replaced. So we are starting to see this upside happening, upside interest and trades going up in March expiry, particularly. And then the other thing I would point out is if we look at the downside and we look at the sub 20 area, which is here, there isn't a lot of interest here. Okay, so I would say that the fact that there's very little activity going on in the downside in VIX suggests that VIX options participants don't see a ton of downside in vol. Okay, and we are starting to think that that might be actually underpriced, right? If the VIX does want to make a new floor this year of maybe 15, then there's some potential very cheap VIX puts down there that are not pricing in hardly any chance of getting down there. So I think that's something we need to think about and something to be aware of, because it might be a good hedge to have in your books, especially if you're holding premium in your books, to own some like 16 strike puts on the VIX a bit further out, because we may go through that floor. Okay, so that's what I'm pondering and thinking about right now. Obviously, the VIX already had a bit of a leg down, so maybe it's a bit late to go out today and buy some. But I think it's just something people need to be aware of and consider. All right, that's it for today. Obviously, Monday's a holiday in the US, so we're going to take a break from the daily, and we'll be back on Tuesday. Catch you then.